Pranam and welcome to my video on Financial Accounting 101. In this video, we are going to learn about the balance sheet. So, these were the three questions that I had shared with you before we started the lectures on accounting. So, over here, balance sheet will give us the answer of what do I own and what do I owe. This is the typical T-shaped, T-shaped balance sheet that we have, traditional balance sheets, where on one hand we have liabilities, on the other hand we have assets. Liabilities are, they're in two parts. One is A, equity, that is owner's money, and B, liability, that is the money that you have got from outside that you have to repay them. Assets are again in two parts, non-current assets or the long-term assets, and current assets or the short-term assets. So what I'm going to do is that we'll take each and every line item separately. We'll try to understand what does it mean, depending on some certain accounting standards or certain Ind AS. So over here, I just put up the consolidated balance sheet of Reliance Industries Limited. We will go through each of them separately. So let us start with the assets first. In that, we take non-current assets. As said, non-current assets are those assets that the company is going to use for more than 1 year. In this case, the first asset that we are going to look at this is known as the PP&E. Now, what is PP&E? It's basically property, plant, and equipment. They are basically those assets of the company. They are mostly the long-term assets of the company that are tangible in nature. It is those assets that we can touch and feel. The examples can be factory, machinery, so on and so forth. The next that we see over here is a capital WIP. Now, it is basically PP&E in making. For example, a company might be constructing a new factory building or might be erecting a new plant. Till the time it becomes operational, the amount spent on making it will be classified as capital WIP. Again, the same concept of capitalizing certain expenses. So it is capital WIP. Then the third is intangible assets. An intangible asset is an identifiable non-monetary assets without physical substance. So you cannot touch or feel that asset. Such an asset is identifiable when it is separable or when it arises from contractual or other legal rights. So examples can be patents, copyright, goodwill, software. Just a caution over here. The goodwill that I am referring to you over here is not the goodwill of the company. It is the goodwill that the company has paid while acquiring some other company. That is, in simple words, it is the amount that is paid over and above the asset value or the or the valuation of the company which your company that you are referring to has bought. So company A is say my company. It is buying company B. If the value of the company B is say 100 rupees, and if I pay 120 rupees, then the 20 rupees that is paid extra in accounting, it is being classified as goodwill. So please remember, the goodwill that you have created by doing good business doesn't come in your books because there is no monetary exchange of money for buying that goodwill. Then the fourth are intangibles under development. Sorry, they are self-explanatory. It means the intangibles which are still under making, like a software development, till the time the last steps like testing, etc., are concluded, the amount spent on coding, designing, etc., will be classified as intangibles under development. The next is financial assets. So as per Ind AS 32, a financial asset is any asset that is cash, an equity instrument of another entity, a contractual right, one that is to receive cash or another financial asset from another entity, or to exchange financial assets or financial liabilities with another entity under conditions that are potentially favorable to the entity, or D, a contract that will or may be settled in entity's own equity instruments and is a non-derivative for which the entity is or may be obliged to receive a variable number of entities' own equity instruments, or a derivative that will or may be settled other than by exchange of fixed amount of cash or other financial assets for a fixed number of shares of the entity's own equity instruments, etc., etc., etc. There's a big definition given to us in Ind AS 32. To summarize, it will be long-term investments that you have made in your associate companies, joint ventures, and some other long-term investments. Examples for other non-current assets would be include deposits related to with the related parties, some interest-free deposit the company gives to somebody. So all these things will be part of your other non-current assets. Then so over here, if I see only the asset side of Reliance, and that too only the non-current asset side of Reliance Industries Limited. You can see over here that major part definitely is made up of your PP&D, because that's your operating machinery, which helps you to produce goods and services. If you can see over here, the movement of non-current assets, earlier it was 9,48,201 crores at 31st March 2021. On 31st March 2022, it is 11,552,646 crores. So the growth in non-current, that is the long-term assets, is 17.74%. This itself tells you that the company is putting huge amount of money so as to grow. These are long-term assets, which are growth assets. Let's come to the critical part of it. Over here, you can see that the plant, property, and equipment. This is the schedule of that. Sorry, property, plant, and equipment. So there are three parts to it majorly. The first is the gross block. So what is the gross block? Gross block is basically the cost of all the assets that you have bought and which are still in your balance sheet. You are still using it. So this is the gross block that we have over here. Okay. So in the gross block also again we have, in the gross block we have three parts. So it is given over here as at 1/4/2021. That is at the opening balance of the asset. Then some adjustments that you make. That is, when you buy, you add it. Some deductions that you made when you sell it or when you just move it out, it's deducted. And at the end is what? It's the it is a closing balance. That is 31/3/2022 pay. What was the land that you were having? So it is opening balance, add additions, less deductions. What you get is the closing balance. But it's basically the cost of all the assets. Okay? So this is the first part, gross block. The next that we call is depreciation, amortization, and depreciation. I think I had suggested you to go through a separate video for it. Again, I'm telling it's very critical to understand this part. So what is this depreciation that you see in the balance sheet? In the P&L also you see a depreciation, but that depreciation is only for that specific year. However, what you see over here is the depreciation that the company has charged over the assets from the first day when the asset was bought. So when I say building, plant, and machinery, till 1/4/2021, they had already charged a depreciation of 10,878 crores on the plant, on the buildings. In this year, how much they have charged? They have charged 4,278 crores, and there are certain minor adjustments of 70 crores. So at the end, it tells you that the company, that is RIL, has till now, that is from the date of purchase of buildings till now, they have charged a total depreciation of 15,139 crores. Okay. This is what we can see is the closing balance. After this, you see the net block over here, which is, what is the net block? Net block is basically the gross block minus depreciation. That is that amount that you get after you deduct the full amount of depreciation from the actual cost. So how do you get this? It is, in this case, if you take plant and machinery, so my gross block at the end of 31/3/2022 was 5,04,872 crores. What I had charged till now was, over here, 1,53,194 crores. So when I reduce 5,04,872 minus 153,194, you will be getting the net block. So basically, what is the net block? Gross block minus the depreciation. This is a very, very important schedule which helps you to understand what is company adding as a growth capital or as a growth asset. जो आगे जाके it might be added to the production capacity. It's really very, very critical. Next, we come to current assets. Now, what are current assets? An asset shall be classified as current when it satisfies any of the following criteria. First, it is expected to be realized in or is intended for sale or consumption in the company's normal operating cycle. It is held primarily for the purpose of being traded. It is expected to be realized within 12 months after the reporting date, or it is cash or cash equivalent unless it is restricted from being exchanged or used to settle a liability for at least 12 months after the reporting date. So basically, they are all those assets that you are going to use within 1 year. In this case, you can see what Reliance has shown. So they have given us current assessment. We have inventories, financial assets. In financial assets, again, we have investments, trade receivables. So let's check them one by one. In current assets over here, first is I am seeing is inventory. Very important for all of us to understand what is inventory. We all know it's stock. Stock, they have been mentioning it in so many types. So they have stock of raw material, including material in transit, मतलब जो माल मूव कर रहा है हाई सी पे है या रोड्स पे, वो भी यहाँ पे ऐड कर दिया गया है. Plus the WIP, that is inventories. मतलब the manufacturing process started on those materials, but they are not converted to finished goods. Then we have finished goods, मतलब sellable, ready to sell goods. Stores and spares, we have stock in trade, that is those things that you have just bought to trade, not to manufacture anything, and some other inventories that they are having. So this is the part of inventory. This is again very critical, very critical. If you are a business owner, you know how important it is to manage inventory, because at the end, inventories will definitely impact your profit and loss. Maybe your cash might get blocked too much if you are not able to use inventory in the optimum way. So managing inventory is really a difficult task. Then next we have is the trade receivables over here. They are what? They are those things basically that you have to receive back. All those people to whom you have sold goods on credit, they are basically debtors. उससे जो पैसा आना है वापस वो है. You can see over here it was 9,104 crores last year. This year it is 23,640 crores. This schedule even gives you some more details about these things. So what they have written over here is that trade receivables which are unsecured and considered good. मतलब there is no security given by the person because आपने सिर्फ उधार पे माल बेचा है, but you feel the पैसा आएगा, मतलब it's considered to be good. Now over here they have again given some what to say breakup of this, which is very important. You can see outstanding for the following period. मतलब you call it the aging schedule of their debtors, or you call it trade receivables aging. So there are people, so we have to receive 2,742 crores of money from people from the last 6 months. So what is the age? The people who are not paid us from last 6 months, then they have said 6 months to 1 year, 1 to 2 year, 2 3 years, and more than 3 years. And there's undisputed trade receivables considered to be good. मतलब ये वो चीजें जो उन्होंने बोला है हम देंगे ही, हम सोचते हैं पैसा आना ही आना है. And they have made so many parts. If you see the second one, undisputed trade receivables, which have significant increase in the credit risk, मतलब लगता है कि शायद मर जाएगा. Then undisputed trade receivables, मतलब उसने भी बोला है कि हाँ मुझे पैसा देना है, but credit might be impaired, मतलब शायद पैसा आया नहीं है, पता नहीं. Then we have disputed trade receivables, मतलब there is a dispute कि पैसा आना है या नहीं आना है. जैसे अमाउंट बोलते 100 रुपया बोलते हैं 80 रुपया whatever, जैसे हम बोलते हैं 120 रुपया, but पैसा आएगा, it is considered to be good. So they are trying to give you so much detail about what they feel is receivable and not receivable. In this case, you can see everything is undisputed and it's considered to be good. Please remember, as the age of a debtor keeps on increasing, the probability of receipt of money keeps on reducing. So it's owner's duty to see to it that majority of your debtors are somewhere below the 3 months range, and it again depends upon industry to industry. Then the next is the cash and cash equivalent. What is cash and cash equivalent in this case? One is cash in hand, actual cash in hand. Then you balance with the banks. It includes unclaimed dividends of so many. So please don't understand if this is full of ये पैसा पूरा अपना ही है, because यहाँ पे they have given that it includes unclaimed dividend of 202 crores. मतलब those people who have not yet claimed their dividend, उनको पैसा देना भी बाकी है. So don't feel कि ये पूरा पैसा हम use कर पाएंगे. So it is critical to understand the makeup of that balances also. Then we have other deposits and advances, which is 9,188 crores. So the cash and cash equivalent, we call it C and CE. As per the balance sheet is 36,178 crores. And the same you get in the cash flow statement, which we are going to do in some other video. So definitely the cash balance has to be same, whether it be in your balance sheet, whether it be in your cash in the cash flow statement. So this was something about current assets. Then we have other financial assets, wherein we have something known as current. We have deposits, which includes a deposit of 17 crore rupees to related party. Then we have call money receivable. Then there are some other things that are there, which are known as financial assets, which are what we say short-term in nature. The next that we see, other current assets are balanced with customs department, central department, excise, GST, etc. जहाँ से पैसा आना बाकी है. Then there are some other things which they have includes prepaid expenses, deposits, advance to vendors, and claims receivables. So these are certain other assets. मतलब if you have prepaid, मतलब जो पैसा कल देना था आज दे दिया है, or you might have to give a deposit so as to get your goods from somewhere, advances that you have given to your vendors. All this will be given where it will be given the other current assets, which are secured and considered to be good. as we move, now you can see over here that we have moved from asset to the liability side of it. Let us start with the first part, that is equity and liabilities. What is equity? We all know it's owner's money, घर का पैसा है. उसमें first part is equity share capital. Now, what is equity share capital? It is the amount that has been actually raised from the owners through either IPOs or FPOs. The actual money that the company got to do business from the owners. मतलब personal खाते से पैसा धंधे के खाते में गया है. That's critical, known as equity share capital. What is the equity? They have profit and loss that are plowed back in business over years. It can also be securities premium, that is money, amount of money charged over and above the face value of security issued. मतलब 100 रुपए का face value है, हमने किया अभी शेयर का वैल्यू 1000 रुपया है, तो जो 900 रुपया एक्स्ट्रा आया, 1000 rupees minus 100 rupees of face value is your share premium account. That is again part of your equity. There can be many types of reserves known as reserves like general reserves, statutory reserve, etc. It is critical for us to understand what these reserves are made up of. Essentially, major part of such things is made up of the profits that you are keeping on reinvesting back in your business. Please remember, the growth of the business will depend on two factors from balance sheet. One factor is, one is the plowback ratio, कितना पैसा आप वापस धंधे में लगा रहे हो, and second is the return on equity, आप वो लगाए पैसे पे कितना कमा रहे हो. These two combined together will give you the growth of the company. Then we have non-controlling interests. What are they? As per Ind AS 110, equity in a subsidiary which is not attributable directly to a parent company. That is the non-controlling interest. Now we come to liabilities, something that the company has to pay to outsiders. What's a non-current liability? Simple, something that you have to pay after 1 year. In that, let us first understand what are financial liabilities. As per Ind AS 32, financial liabilities, any liability that is first a contractual obligation to deliver cash or other financial asset to other entity, or to exchange financial assets or financial liabilities with another entity under conditions that are potentially unfavorable to the entity. Or B, a contract that will or may be settled in entity's own equity instruments and is a non-derivative for which the entity is or may be obliged to deliver a variable number of entity's own equity instruments. Derivative that will or may be settled other than by exchange of fixed amount of cash or the financial assets of fixed number of entities own equity instruments. This is a definition as per Ind AS 32. Let us understand more about it. So first is the borrowings. What are borrowings? We all know that borrowings can be of two types, secured and unsecured. What is a secured borrowing? Secured borrowing is basically the amount of loan that you have raised by giving an asset as a collateral. What is unsecured? Amount that is raised from the market without giving anything as security or collateral, which will be more costly. Definitely unsecured loans might be more costly than the secured loans. When you go in depth of this, say schedule 16 that is shown as borrowing, you might get host of details like the RO, that is a rate of interest, maturities, and so all these things will be available in the schedules. What is the rate of interest that which you've taken, when all things are getting matured to be paid. So this all things would be a part of the schedule. In this case, is part of the schedule number 16. Then after this we have lease liabilities. So Ind AS 116 introduces a single lessee accounting model and requires the lessee to recognize assets and liabilities for all lease with a term of more than 12 months, unless the underlying asset is of low value. A lessee is required to recognize the right of use assets representing its right to use underlying leased asset, and lease liability representing its obligation to make the lease payment. Ind AS 17 required to classify lease as financial lease and operating lease. The same is not given under AS 116. So what is lease liabilities? वो asset जो आपने lease पे लिए हुए हैं, जिस पे you are paying the lease rentals. Lease rentals can use क्या, there are two parts to it. एक होता है you pay, उस lease rental में there will be one part that is known as principal repayment, other is the interest that you are going to pay. So these are lease liabilities. Then we have deferred payment liabilities. There is an amount that is included in a company's account for money that it owes, but it will not pay back at a future till the will be available the future date only. मतलब अभी नहीं देगा, बाद में देगा. तो यहाँ पे if you see, you can say that it's payable to the in this case you can see that in Reliance case, it is deferred payment liabilities. They have been given again non-controlling current. Unsecured, they are there, payable to the Department of Telecommunication. So these are those liabilities that you might have to pay, but not today, after some time. They are the deferred payment liabilities. Suppose that we have Other financial liabilities, they are those liabilities, that those long-term financial liabilities that are not any of the above. Matlab, if it is not a borrowing, not a lease liability, not a deferred payment liability, you classify it as a other, as a long-term financial liability. In this case, if you see the case of Reliance over here, we can see that we have other financial liabilities, non-current. Other payables, they have written that interest accrued but not due on deferred payment liabilities, deposits, creditors of capital expenditure. So it includes interest accrued, matlab, you have to pay, but आज नहीं बाद में देना है, वहां पे डाल दिया है. Then we have deposits and creditors for capital expenditure. All these things are a part of my, non other financial liabilities, non-current. After this, as we move ahead, we have provisions. What's the provision? It's a liability of uncertain timing or amount. Provision can be distinguished from other liabilities such as trade payables and accruals because there is an uncertainty about the timing or the amount of future expenditure required in the settlement. मतलब भरना है, but कब भरने को आएगा, कितना भरने को आएगा, both can be dicey. So in provision, which are non-current, is long-term in nature, ये आएगा, but अभी एक साल में नहीं, एक साल के बाद आएगा. When you don't know. So there's provision for annuities, provision for decommissioning of the assets, okay, and others. So when you see this decommissioning of assets, there is a star mark over here. What does it read? It reads the movement in the provision towards a utilization of TAPTI facilities. So they have given you more about what they feel are the are the liabilities that they might have to pay the future probable time. So it's they have tried to estimate kitna shayad aayega, but it can be more, it can be less. Then you have deferred tax liabilities. This is very, very critical to understand. Please remember, income taxes are paid depending upon income arrived as per Income Tax Act. However, what you see or the income that you see in the annual reports, it is prepared as per the rules of Companies Act, not as per the Income Tax Act. So whenever the income as per Income Tax Act is lower than as per Companies Act, there is the creation of a deferred tax liability. Matlab, as per me, by sheer accounting logic, I say that कि मैंने 100 रुपए का income किया है profit before tax. However, उसमें supposing I might have bought certain assets जिसमें I have got huge amount of depreciation in the same year. क्या हो रहा है? My calculation of income as per Income Tax Act says that नहीं, I have earned only 80 rupees, not 100 rupees. It was Company Tax says. तो जो 20 रुपया है, where I am showing lesser income in Income Tax Act, तो 20 रुपए पे जो टैक्स बच रहा है, that you call as deferred tax liability. Please remember, वो टैक्स आज बच रहा है, मतलब आज आपने प्रॉफिट नहीं बताया, बट नेक्स्ट टाइम आपको प्रॉफिट बताना पड़ेगा. So that you call defer. You are just deferring the tax liability. आज नहीं, कल भरेंगे. Is good or bad? Definitely, any payment that you can make after a certain amount of time without having any penalties on it, it's good. मतलब cash बाहर नहीं जाना without any penalties, definitely good. Okay. So we have deferred tax liabilities over here, net. In this case, they have given us the deferred tax assets in relation to what are the reasons of creating these things is over here, and what are the reasons of not creating is over here. So they have given you actually कैसे create हो रहा है. This is very critical for you. You can definitely ask your chartered accountants to tell you how can these things work for you in your benefit. Then the next is the rest all items, the meaning remains same as that for the non-current liabilities, except that these liabilities have to be paid within 1 year. मतलब you take borrowings, या lease liabilities, all those liabilities same as we had done in the current non-current liabilities. The only thing is that वहाँ पे they were to be paid after 1 year, यहाँ पे they have to be paid within 1 year. In the case of provision over here, when you say current provisions, तो यहाँ पे mostly they are provisions for made for tax, income tax भरना है, GST भरना है, they are those provisions. At the end, if you see, the total of assets has to match. Why? Because what is assets? This is application of money. What is liability? It's the source of money. तो 100 रुपया अगर आया है तो 100 रुपया लगना चाहिए. It cannot be कि 100 रुपया आया 80 रुपया लगा या 100 रुपया 120 रुपया लगा. So it has to be totally matching to each other, which matches it over here. So please remember this, what to say, equation. Assets are equal to equity plus liability, where equity has two parts: contributed capital and retained earnings. That is our other equity, as we say. Other equity, how do you get it? It's other equity at the beginning of the year plus net income for the period minus the dividend for the period. How do you get the income for the period? It's sales minus the expenses. This is very critical for us to understand. I'll again put up the the link to the Reliance balance sheet below this in the description of this video, and the key takeaways from the balance sheet I'll also put up in the description. I hope this video might help you. Thank you so much.